Joining me right now is Mike Philbrick, President of Resolve Asset Management. Mike, it's great to be here with you. Yeah. We're at Inside ETFs. It's great to have you and to catch up with you here.
Yeah, it's always great to connect.
Yeah. So before we get started, were you on a panel today?
I'm on a panel tomorrow.
Oh, tomorrow. Okay. And what are you guys going to be talking about?
We're really talking about how to build portfolios using ETFs. What really the ETF is an innovation or technological innovation, and so we've got an adoption curve, and sometimes people are slow to implement those technologies within the portfolio. And right now there's pretty significant gaps between a portfolio in Canada, which is generally sort of 71%, somewhere between 70 and 80% Canadian stocks and bonds, when Canada represents only 3% of the global stock and bond universe.
Yeah.
So we have a pretty massive home country bias. And so we're going to be talking about how you might diversify appropriately away from Canada, what opportunities are sort of like low-laying fruits, low-hanging fruit to improve the risk-adjusted returns for portfolios. And in doing so, help people achieve their goals, their financial goals, more reliably. So we'll dig into that a little bit.
You know what's interesting is I think it's really funny when you look at the new language. I look at for example, like elementary school, the way reading is being taught right now, and they have things like or math. Math facts.
Yep.
What's a math fact, right?
Yeah.
And then in reading, making connections, text to world or
terminology.
So see how things have changed. Like even teaching has changed. Mm-hmm. Right, but the financial industry has changed as well. And I think because the advent of ETFs, maybe I don't know if it's because it was from academia, a lot of it. Yeah. Passive investing. So these Greek terms, beta, alpha, gamma, vega. I was listening to a podcast, and there was so much of this back and forth about these math terms. I have a feeling that the math terms like beta, smart beta, alpha, that has a lot to do with why some of the adoption is a little slow.
Yeah,
right? Like if you're reading like sometimes you read quantitative commentary from Cliff Asness, right? Equations like as soon as you get to the equation, it's like, okay, I don't get that, right? And so unless you're a mathematician or you understand, arrays and calculus and right, it's probably beyond, like in the immediate, it's probably beyond the grasp. So it's really great when you can take something like multi-factor and demystify it into, it's the equivalent of saying diversify,
right,
or smart beta.
Yeah.
What's his name? There's a guy in England who runs an evidence-based blog.
I know who you're referring to.
Robin.
Right, exactly.
Right?
Yes,
And I think the term evidence-based investing or rules-based investing is a much nicer, a much more elegant way of describing smart beta.
Yeah, certainly.
Right? Smart beta is a variation on indexing.
Yep.
Right? Somehow.
Absolutely.
Rules. But so, you were speaking about adoption, like sometimes it's slow or, Art Johnson this morning said it's like 12 to 18 months to get some advanced people in the industry up to speed on, the transition into making, fee-based.
Yeah.
Running your business as a fee-based advisor. Or, and you talked about earlier how big the barrier to entry is to going fully independent.
Very true.
Compared to how it is in America. You guys, you and Justin Castelli were talking about earlier, which is like it's unbelievable how hard it is for Canadian advisors to become fiduciaries.
Very true.
In the full sense of the
Very
meaning.
True.
But having said that, and coming back to the language, and I know I'm doing all the talking here, but
it's fine.
But these terms, alpha is outperformance of something, right?
Yeah.
Degree of outperformance. Beta, which is the index return, but smart beta, which is really applying rules to indexing.
Yep.
What is gamma? Okay,
You're gonna
you know what?
test me
You know
on
what? We're
gamma.
going to lose. I don't want to.
Vega, gamma.
Okay,
now I got to
never
go back to my options.
Never mind.
training.
But I think just to make a point, I think those terms are the reason why maybe some of the more long time people in the business are having difficulty maybe adjusting.
Yeah, adopting, adjusting.
Yeah, it's a learning curve, right? It's a really long on ramp.
We in finance do a horrible job of making these concepts approachable.
Yeah,
and I think that does provide resistance to people moving up the adoption curve because they are hard to understand. They are nuanced, and you have strategies, whether they're smart beta or you're trying to extract some excess return from the market, that play out over longer time periods, and people's expectations are short term. Mm-hmm. And then we've got things like hyperbolic discounting that goes into human decision making, and I think something like the low vol anomaly, or the minimum variance portfolio construction, which also tries to mitigate volatility in the portfolio. I think that's exploiting, if you will, that hyperbolic discounting mechanism that humans have, in that they want very high returns in the short term. So if they observe their portfolio in the short term, they want very high returns. And if they look at it in the long term, they're willing to accept, a much lower rate of return. But it really is foregoing the lottery payoffs and the things that are very high risk in your portfolio, and sort of keeping that arithmetic mean, that average of returns that's arithmetic, transitioning to the geometric, i.e. the compound returns, keeping that difference as small as possible. So high volatility degrades long-term geometric returns, right? So if I lose 50%, I have to make 100% back to get back to break even. So when you remove sort of the high-risk stocks from the portfolio, which whether low vol or minimum variance, both of them have ways of doing that, you actually increase the long-term rates of return. But it's not because of what you own. It's because of what you don't own that's driving the enhancement in the portfolio. And you're right, finance does a very poor job. I mean, it's unavoidable. So where is that idea going to germinate? Well, initially it's going to germinate in very small areas, very niche areas. We talked about this before going on, that I was in a training class at Nesbitt in 1992, 93. And we had the head of utilities and banks come in and explain, like, you want to own these stocks and they're less volatile. It hadn't been coined the low vol anomaly yet. It was known wisdom from
it's almost
the world.
It almost feel like saying "duh" when you hear that.
Yeah,
like duh.
Totally.
Why wouldn't
but
you?
In the short term, we want to buy marijuana and blockchain because we want it right now. That's hyperbolic discounting. That's what humans do. That's a frailty.
They still want the excitement.
Right. Yeah. So how can we protect ourselves against ourselves? Right. And some of that is codifying the rules.
Yeah.
Putting them in a place where we can reference them and say, well, here's why this anomaly should work. Okay, this behavioral flaw, or maybe it's driven by some economic reasoning. So here's why it should work. And let's codify that and pull that out of the brain of the portfolio manager from 30 years ago, put that in rules and offer that broadly to the investing public through ETFs. The challenge.
So I mean, that was it's interesting because the conversation with Art this morning was about this Harvard study.
Right.
That in a nutshell, investors like algorithms.
Simple
right?
ones.
Yeah, simple ones. Yeah. But they like, by algorithms, obviously, the set of rules. That determines how money is invested in this case. So when you have that system of rules, you can more easily, I think for one, you can more easily build a core portfolio.
Sure.
Like an optimized core portfolio. But then that could free you up to do the exciting stuff at the fringe.
Sure.
Like, you got 90%, 80 or 90% of your portfolio in this core, equities, bonds, alternatives, like a fully optimized, like multi-factor, diversified portfolio. And then at the fringe, you can explore, like with I know there's a name for that, it's pour and explore, but
certainly.
But explore, you can give your clients the opportunity to explore some of those exciting or hyperbolic areas.
And I think the point that you made initially is that in this world of sort of complexity, and finance tends to overcomplicate things, we have a saying, as simple as possible, but no simpler.
Yeah.
And so you've got some folks some allocators, investors would view factors and factor exposures as explore, not core.
Yeah,
and
that's wrong, right?
I'm not sure it's wrong. I think it's wherever that person is, right?
Yeah.
Where is that person in their journey?
Yeah.
And how do they view that factor? Do they view that as something that they can count on? And oftentimes that's not driven by their own research, it's driven by their peer group, right? We do like to herd together. I think, so what ETFs are doing is they are broadly educating, and they're democratizing these factors. They're taking them out of the master builder, i.e. master portfolio manager. He's got it as part of his DNA, his wetware, if you will, that is deciding, using these factors and his experience to put it into a portfolio. Now what we're doing is codifying the rules and then offering them more broadly, which has its own set of consequences, intended or otherwise, which is if we codify any factor and then allow mass adoption of that factor via ETFs.
Right.
So now we've got billions and billions of dollars arbitraging what was an investment opportunity previously, which will, by definition, shrink the amount of excess return available because more people are arbing it away.
Efficient.
Right, the market becomes efficient. So you have to be careful where certain factors are in the adoption process. So let's look at price to book as an example. A very well-renowned value factor that all the research is based on. Mm-hmm. Very large pools of capital, like DFA as an example, use that in order to inform their decisions about value. So part of the issue with price to book's lack of performance in this cycle, and especially against other value factors, may be that there's different ways to look at a balance sheet. And the high-tech world doesn't really capture price to book. It's not an efficient way to measure value. Right. And so part of it might be that. Part of it also might be there are large pools of capital that are using that evidence to deploy capital. So that's going to shrink the edge that comes with that.
But then, so that would be a factor that you'd want to avoid.
Well, you'd want to diversify away from. Right?
Yeah.
So I wonder. So we sort of explain this in this way. So the Event Horizon Telescope recently was able to take a very clear picture of the black hole. So that's a very hard thing to do. So hard, the data that was required had to be transported by truck because it was not able to be run through the pipes of the internet. Right. It was too much data. So we are talking about a massive undertaking. What people don't realize is the Event Horizon Telescope is many, many, many telescopes in 8 different geographical positions all across the world.
Right.
And this is part of information science, is that if we took one telescope and tried to take a picture, we get a very blurry image. It's not really much to make out. But with the many telescopes at 8 different positions on the globe working together, you get a very crystal clear picture of a black hole. Remember, black hole is
like a triangulation.
Yeah. It's the gravity is so intense, light can't even escape. So you're just looking at the fringes of the black hole where light can escape to take this very, very small point in space. So what does that have to do with investing? Well, we would argue that sussing out the value signal is an example. Trying to ascertain what the true value signal is from this basket of stocks, North American stocks, Canadian stocks, US stocks, doesn't matter. But we're trying to figure out what's the true value signal. If we're only using one antenna, we got lots of noise, and we're trying to get this kind of weak signal. Rather, let's take an ensemble approach. We're big on ensemble approach as a result. Let's take an ensemble approach, an Event Horizon Telescope approach with many telescopes at 8 positions in the world. So that would be akin to price to book, enterprise value to EBITDA,
all these different
earnings,
measures,
all the different measures of value, and then letting the error terms cancel each other out, and then we get a much, much stronger signal underlying that informs us. Because what are we trying to do? We're trying to find out which stocks
So you're talking about a
truly
screen.
the most. Yeah.
Yeah.
Well, it's a screen that uses an ensemble approach, many different measures of value,
and then cancels out
and then puts
the
them
noise.
together. So you have a series of weaker edges, but when you amalgamate them together, they become a strong edge.
Right.
And when we've looked at this, whether it's different momentum measures, we have a paper we did on these different momentum measures. And when you take many momentum measures rather than just one, so like the 10-month moving average or the 12-month moving average, different sort of well-adapted. Well, you take one, that's fine, and it's a heuristic, so everyone gets it. Everyone will do it. You're comfortable. What's the 200-day? I've heard about it. I know it, so I feel comfort with it. The fact of the matter is, we've got, we built 1,224 of these potential indicators, all effective, right? All looking back at momentum for the last 1 month to 13 months. When you do that, you find that using that average signal outperforms 90% of all the individual measures. So you have to be so good. If you want to outperform the ensemble approach, you have to be able to pick the one out of the 10% that outperform that. Now, on a risk-adjusted basis, if you take risk into account, it's 99th percentile.
Right.
So, but that's complicated, right? And
it is.
The complexity that people are like, I don't understand it, I don't want to use it. And I don't know about you, but I don't quite know how my toilet works, but I'm going to use it anyway.
Yeah.
Right? I'm not going to go to the outhouse. There's some things I sort of have to, there's some science. Yes, the bar is a little higher. If you'd like to capture larger excess returns that have not been arbitraged away, you should always think that you're going to have to do a little bit of work that other people aren't doing. You're going to have to be a little bit uncomfortable.
I think that's always been true in one way or another.
Get comfortable with being uncomfortable.
Yeah.
That's a saying we have, because it doesn't, if you're doing what everybody else does and everybody else is doing this thing, the arbitrage by definition must have shrunk the opportunity for excess return. And so I think it's wonderful the way ETFs are democratizing finance in that sense. They're putting those rules out there. They're offering, there's large ETFs that are looking at capacity when they build those rules. Right? And so BlackRock is going to be, when they're thinking about the value factor, they're going to be thinking, okay, well, this value factor has to sustain billions of dollars in order for us to launch a product.
Right.
Whereas if we look at Alpha Architect in the US, a much smaller shop, and they suss a much more vigorous definition of value. You're going to get truly value ugly stuff, which is great. That's what you're looking for. So they're not building that product for capacity. They're building it in order to suss out the value factor. I think that that's a level of nuance we might be at. And I know we've got people at the conference who are at the beginning of their ETF journey, in the middle, and some who are well adopted and understand the processes very well. But again, it's going to be a stretch. If we think about knowledge as a continuum from 1 to 10, and you're at level 2, then you got to strive to get to level 3 and be comfortable with level 3. If you just jump to level 7,
I think but from what you're saying, if you have a sophisticated enough, and what you're talking about is sophisticated, like this ensemble approach, you can put that to work for you without, once it's in place and it's working, you can leave it there. You don't have to.
You shouldn't
do it. It could be the gift that keeps on giving.
Yes.
That's the idea.
It
keeps on producing results that are superior,
right,
based on whatever it is you're trying to accomplish.
Exactly.
And it's not about beating the market. It's about accomplishing what you set out to do.
Yeah. Well, I mean, in the end, what is a factor? It's an anomaly in the market that exists for either an economic or behavioral reason.
But so you're still talking about outsized returns, but it's
you
not,
should be. Yeah. I mean, but they may not match. Again, we come back to, let's look at the value factor. It has underperformed dramatically in this cycle. Does that mean value's dead? Does that mean the uncomfortable position of buying what is disliked and underowned is gone? I don't think so.
Once the thing is working, you can step away from it and watch it work. You can actually see is it working.
Until such time as you might have to make a decision as to, price to book is a great example.
To tweak it.
Is it broken? Yeah. Is it gone forever?
Yeah.
And really, to be honest, we don't have enough data.
But it's kind of like adjusting the trim on a speedboat.
Correct. And then why take the risk of just one factor?
Yeah.
Why, if we're going to capture the value signal, let's use an ensemble. Let's look at various different edges in value. different signals. They're going to cancel out their error terms, and we're going to get a stronger signal. And this is pervasive, right? It applies across momentum indicators. It's cross-indicator effective too. So when you start to think about trend is something everybody loves. If you inform your trend with carry, it becomes an even better signal. So when carry is in your favor, trend is much more effective. And when carry is against you, trend is less effective. And carry simply is what's my yield of, I want to be long the higher yield thing and short the lower yield thing.
Right.
Whatever, those two things are. And so again, you get not only within the factors themselves, but cross factors can be very effectively amplified. It becomes a force multiplier. And then here's the problem. Now we're descending into language like gamma, beta, alpha, and people are probably scratching their head and tuning out. So how do we do that? So the bottom line is it's learning. Right? It's the new math. I love that in The Incredibles too, where he's trying to teach his son math. He's like, why would they change math? But it's evolved.
It did.
I'm sure that the advisor, the 40, 50-year-old veteran of advising, he's looking at ETFs going, why would they change investing? Why would they do that? And
I think it's because teachers have teaching guides now.
Yeah, true enough. Well, the advancements in science happen one death at a time. I kind of think that is we move as a population through this, and you have to decide where you're going to sit and what value you're going to add. Are you going to be more, I want to sit right in what's tried, true, I'm not taking any risk, or I'm going to do 60% that and do the explore with 40, keeping in mind that as you move from sort of well-accepted to frontier, you should also be getting rewarded for that. I think this is where we have to be very careful about this hyperbolic discounting effect, because when people, let's say we think about blockchain as a brand new frontier technology and a frontier potential for an investment class. I'm pretty sure that anybody that entered that sort of a year and a half ago, they were entering it for the wrong reason. It was envy. It was the recency bias of the performance. They were performance chasing. Rather than thinking about it from the perspective of, is this an asset class that actually has some sort of meaningful contribution? What would be an appropriate allocation for that? And when might I enter?
Yeah, it's more emotional than
it's
rational.
Totally emotional driven. So you might be a frontier person who takes those types of investment opportunities, very seriously. But it shouldn't be driven by their recent performance, I guess is what I'm saying. It should be driven by more of a process. The outcomes.
Those are all those sort of classic markers that people used to, that investors inform themselves with, right? You see the track record of a fund or an ETF, and you say, I think I want to buy that. It did really well last year, and then the next thing you know, it underperforms the following year.
Yeah, and they don't like it. I think you should be impatient with executing those long-term processes that will drive long-term excess returns. And you should be very patient with the realization of those longer-term outcomes. Right? Impatient with process that you can control. Impatient with your learning, making sure that you're sort of on the leading edge of whether it's factor investing and whatnot. You should be impatient with those processes. You should be very patient in observing what the outcomes are. Otherwise, you just end up on this treadmill of constant change. And nothing ever gets to actually take hold and take root in your portfolio.
Yeah, so that's where the systematic investing takes all that out.
Yeah, it helps.
And then you can just ignore it.
Correct. That's what you should do.
Mostly, benign neglect.
Right. But continue to look at new processes that you might introduce. Yeah. You may introduce it initially as a core, and then over time it migrates. Or you might introduce it as explore, and over time it migrates to core, right? So if you think about some new factor, whatever it be, momentum, and you're like, I don't know momentum. I've got value. Value's a core factor for me, but this momentum thing I'm not sure about, for whatever reason. So you have it as an explorer. Then you get more comfortable with it. You see how it works both in up and down market, and you see, what, momentum is actually that factor. Maybe that's a core part of my portfolio, not explore. And the next thing that's explore is some other asset class, commodities, real estate, frontier markets in countries, emerging market bonds, whatever the case may be. And then you gently work those through your process of discovery.
No matter what, it has to be gradual because,
It should be.
There's only so much that
it should be.
Right? There's only so much of this. Like, you can overwhelm your clients with this stuff.
And I shouldn't say that. When I say it should be, I mean, what's the objective function? Well, I have money. I'm planning for the long haul, and I have this income stream, whether it's my job or whatever, and I'm putting money in, and then I have this pool of money, and I retire, and now I'm going to take money out. Those things are slow accumulation, slow decumulation, getting rich slowly. If your objective function is to create massive wealth, then the way to do that is to be on the cutting edge and take concentrated bets.
Yeah.
But that's not what most people are doing. That's not what this conference is about. That's not what we do. But if that was the function where I'm like, no, I'm looking to maximize terminal wealth, well, you do things like start up small businesses.
Yeah.
You have very focused bets in very focused areas, and you lever those bets.
It's going to depend on what the objectives are.
Correct. So I misspoke a little bit in the context of the conversation we're having here. Absolutely, those are things that should be at the forefront.
Thank you.
Always a pleasure.
Awesome. Thanks, Mike.